Hey everyone, welcome back to Corporate Decoder, the place where we decode the not-so-simple language of corporate finance. And today we are diving into a filing that essentially sets the stage for some major borrowing and debt issuance by two very big players, Morgan Stanley and Morgan Stanley Finance LLC, which for us basically means a whole new set of debt instruments are on the horizon. Now, before we dive in, if you appreciate getting straight, unbiased insights from these dense corporate filings, make sure you are subscribed and also hop into our Discord community. We have a link in the description below. It's a great place to chat about all things corporate finance. Alright, so what we have here is a Form 8K filed on the 23rd of September 2025. This is a current report, and it is all about new developments that are important enough for the public to know about right away, and in this case, the big news is all about debt instruments, what we call debt securities. Basically a fancy way of saying the company is issuing new forms of loans that they will pay back later with interest. So the main players here are Morgan Stanley and Morgan Stanley Finance LLC. Think of Morgan Stanley as the big parent company, the known investment bank, and Morgan Stanley Finance LLC as a subsidiary. It is like a wing of the company created specifically to handle certain types of financial activities. And in this report, they are talking about updating their master note documents. Now, you might be thinking, why would I care about a company updating its loan paperwork? Well, this is how companies like Morgan Stanley raise a lot of money to fund their operations, to make big investments, or to simply manage their finances effectively when they update these master notes. It means they are getting ready to issue new types of debt, perhaps with different terms, different interest rates, or different maturity dates. Think of it as getting a new standardized contract ready before they go out and borrow more money from investors. The filing specifically mentions two main areas. First, Morgan Stanley. The parent company is updating its form of master note for its global medium term note series. This is like getting a standardized template ready for a whole series of debt offerings they might do down the road. The second part is for Morgan Stanley Finance LLC, which is updating its form of master note for its global medium Term Note Series A. This is also about creating a go-to document for their upcoming debt issuances. So essentially both entities are preparing their paperwork to potentially borrow more money and diversify their sources of funding. It is also interesting to see the types of securities already registered and trading on exchanges. Like the New York Stock Exchange, we see common stock, of course, but also various series of preferred stock, like Series A, Series F, and so on. These are different types of ownership stakes in the company with different rights and benefits. And then you have those medium term notes we talked about, like the fixed rate step, up senior notes due 2026, and floating rate notes due 2029. These are all different ways the company has raised money in the past, and these new master notes are likely to cover similar or new kinds of debt. The inclusion of ISO 4217 USD here simply means that these debt instruments will be denominated in United States dollars, which is pretty standard for a major US financial institution. And the XBRBLI shares tags simply indicate that the quantities being discussed are in terms of shares, which for debt instruments typically refers to the number of units or par value of the debt securities being issued. Looking at the details here, we see a long list of securities. This is where things get a bit nuanced, but at a high level it shows the breadth of financial instruments Morgan Stanley uses to manage its capital structure. We have common stock depository shares representing interests in preferred stock and various medium term notes, all trading on the New York Stock Exchange. This specific entry tells us about a particular type of debt, the global medium. Term note series, a fixed rate step. Up senior notes due 2026, issued by Morgan Stanley Finance LLC, the fixed rate step. Up part means that the interest rate on this debt will start at a certain rate and then increase or step up at specific points in time, often on anniversaries of the issuance. And it is a senior note, meaning in case of bankruptcy. These note holders get paid back before holders of more junior debt. And this is the identifier for Morgan Stanley Finance LLC itself. This one, on the other hand, is for floating rate notes due 2029, also from Morgan Stanley Finance LLC. The floating rate means the interest rate on this debt will change over time based on a benchmark interest rate like LIBOR or SOFR. This can be good for the company if interest rates fall, but bad if they rise. The registrant S telephone number, including area code, is 212 761 to 4000. This is important as it is the main point of contact for the company. This detail refers to the Series L preferred stock, which is another class of preferred stock Morgan Stanley has issued. Again, preferred stock is a type of ownership that has priority over common stock in dividend payments and asset distribution during liquidation. but typically does not have voting rights like common stock. Similarly, this indicates Series O preferred stock, another way Morgan Stanley raises capital through equity instruments. And this points to Series P preferred stock, rounding out the list of specific preferred stock series. And finally, Series Q preferred stock again, highlighting the diversity of capital instruments available to Morgan Stanley. Now, looking at the signatures at the end, we see Kevin Sheehan as Assistant Treasurer for Morgan Stanley and Erin Page as Secretary and Counsel for Morgan Stanley Finance. LLC, these are the authorized representatives signing off on this report, confirming that the information provided is accurate. Now let's talk about what this all means for investors and for the company itself. This filing doesn't give us specific dollar amounts for the new debt. It is more of a procedural update, a preparation for future borrowing. But what it does signal is that Morgan Stanley and its finance arm are actively managing their debt structure and likely planning to raise more funds. This could be for various strategic reasons, perhaps to fund acquisitions to grow their lending business, or to simply replace maturing debt with new issuances for Morgan Stanley, a company of this size. And scope debt is a necessary tool for operation and growth. The ability to issue both fixed rate notes and floating rate notes gives them flexibility depending on their outlook for interest rates fixed. Rate debt is predictable, especially if they expect rates to rise, while floating rate debt can be cheaper. If rates are expected to fall, the fact that they are updating these master notes suggests they are being proactive in their financial planning and ensuring they have the right legal and procedural frameworks in place to access capital markets efficiently. However, it also means an increase in the company's leverage or debt levels. While debt can fuel growth, it also brings risk. Higher debt levels mean higher interest payments, which can impact profitability, especially if revenue or profits falter and in an environment of potentially rising interest rates, like we are seeing. The cost of borrowing could increase, making these debt instruments less attractive. Looking at the broader picture, Morgan Stanley is a giant in the financial world. Their ability to raise capital efficiently is crucial to their business model. This report is a behind the scenes look at the mechanics of that process. It shows they are a mature company with established processes for debt issuance from a strategic perspective. This move on debt issuance is likely calculated. They are not just borrowing blindly, they are setting up the infrastructure to do so in a controlled and regulated manner. We need to monitor how these new debt issuances are priced and what terms they carry to really understand the immediate financial impact. So to wrap up, this filing is a signal of continued activity in Morgan Stanley's debt markets. It is a sign of a company actively managing its financial health and pursuing growth opportunities through borrowing. Remember, debt is a tool, and like any tool, it can be used to build or to break. Its effectiveness depends on how it is wielded and the prevailing economic conditions. What's your take on Morgan Stanley's strategic use of debt? Do you see this as a positive sign for growth or a potential red flag for increased risk? Let us know your thoughts in the comments below if you found this breakdown helpful. Give us a thumbs up and please subscribe to Corporate Decoder for more simplified financial insights you can trust. Also, don't forget to join our Discord community linked in the description. Thanks for watching, and we will see you in the next Decode.